Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Centene Corporation Annual Report. Centene Corporation is a healthcare enterprise that offers a wide range of programs and services to underinsured and uninsured families, as well as commercial organizations in the United States. The company operates through four main segments: Medicaid, Medicare, Commercial, and Other. The Medicaid segment provides various healthcare products and services, including temporary assistance for needy families, Medicaid expansion, aged, blind, or disabled programs, children's health insurance programs, long-term services and supports, foster care, and Medicare Medicaid plans. The Medicare segment offers special needs and Medicare supplement plans, as well as prescription drug plans. The commercial segment provides health insurance marketplace products for individual, small, and large group commercial clients. In addition to these segments, the other segment operates clinical healthcare and pharmacies, offering vision and dental services, behavioral health services, federal management services, and corporate management services. Centene Corporation also provides services through a network of primary and specialty care physicians, hospitals, behavioral health practitioners, and ancillary providers. With its extensive range of programs and services, Centene Corporation has established itself as a leading healthcare enterprise in the United States. Centene Corp's stock price drop. A year of uncertainty in the past year, Centene Corporation's stock price has plummeted by over 28.49%, with a significant decline occurring in July 2025. The main catalyst for this downturn was the company's withdrawal of its full-year 2025 financial guidance due to several unforeseen factors. One major contributor to the decline was higher-than-expected healthcare costs, particularly in Centene's Affordable Care Act, ACA, and Medicaid plans. Additionally, the company faced weaker growth in ACA insurance markets, with slower-than-anticipated enrollment growth across most states. Furthermore, new enrollees in Centene's ACA plans were found to have higher morbidity rates than expected, making them more expensive to insure. The projected shortfall in risk adjustment revenue was another significant concern, with an estimated $1.8 billion shortfall for 2025. This translated to a potential $2.75 per share reduction in adjusted earnings. The Big Beautiful Bill Act also weighed heavily on investors' minds, as it was forecast to slash $1 trillion from Medicaid, a program that accounted for a significant portion of Centene's revenue. These factors collectively led to investor uncertainty about Centene's future performance and prompted analyst downgrades, resulting in the dramatic stock price drop. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a health insurance company can be attributed to several key factors. On one hand, revenue growth is driven by an increase in membership across different segments, such as Medicaid, Medicare, and Commercial. Premium rate increases in these segments also contribute significantly to revenue growth. Additionally, risk adjustment payments from CMS for risk adjustment programs based on membership acuity and subsidies and reinsurance payments for marketplace contracts further boost revenue. On the other hand, revenue decline is primarily caused by a decrease in membership across different segments, leading to a reduction in premium revenues. The return of premium programs also contributes to revenue decline, as well as divestitures such as the sale of Magellan Health. Segment-wise analysis reveals that the Medicaid segment declined due to membership attrition and rate decreases, while the Medicare segment increased due to risk adjustment payments and premium rate increases. The commercial segment saw an increase in revenue due to membership growth and premium rate increases. In terms of cash flow, net cash provided by operating activities decreased from $2,163 million in 2023 to $1,112 million in 2024, while net cash used in financing activities decreased from -$1,576 million in 2023 to -$2,394 million in 2024. Overall, the company's revenue growth and decline are influenced by a complex interplay of factors, including membership growth, premium rate increases, risk adjustment payments, subsidies, and reinsurance payments. Net income experienced fluctuations between 2023 and 2025. Initially, it increased from 2023 to 2024 due to higher star ratings and additional Medicare revenue. However, this trend reversed in 2024 to 2025 as a result of increased health benefits ratio, HBR, higher than expected medical costs, and uncertainty surrounding healthcare regulations. Profit margins also underwent changes during the same period. They improved from 2023 to 2024 due to more attractive benefit packages offered to members and higher profit margins achieved. Conversely, they narrowed from 2024 to 2025 due to relatively small changes in HBR, which can significantly impact financial results. The key drivers of these changes include various factors such as goodwill impairment, medical claims liability estimates, premium deficiency reserves, completion and cost trend factors, uncertainty surrounding healthcare regulations, increased health benefits ratio, HBR, and higher than expected medical costs. These elements collectively contributed to the fluctuations in net income and profit margins between 2023 and 2025. The company is indeed generating positive operating cash flow. This is evident from the financial data presented on page 62 of the report. For both 2024 and 2025, the net cash provided by operating activities has been reported as a positive figure. In 2024, the company generated $154 million in positive operating cash flow, indicating that it was able to produce more cash than it consumed during this period. Similarly, in 2025, the company's operating cash flow surged to a significant $5,088 million, further solidifying its ability to generate positive cash from its core operations. These figures suggest that the company is managing its finances effectively and has a strong foundation for future growth. The consistent generation of positive operating cash flow is a key indicator of a company's financial health and stability. The company's debt level has experienced a slight decrease over the past few years. According to the extracted summaries, total debt decreased from $18.4 billion to $17.4 billion between two unspecified periods. Additionally, long-term debt saw a 6% reduction from $18,423 million to $17,351 million during another time frame. In terms of interest expenses, there has been some fluctuation. Interest expense decreased by $24 million in 1 year, but increased by $47 million the previous year. However, it's worth noting that interest expense also saw a slight increase of $23 million from 2024 to 2025. Despite these minor changes, no significant shifts in debt level or interest expenses are mentioned for several other periods. The performance of various segments and regions within the organization has been analyzed. The Medicaid segment stood out as a top performer, generating $110,434 in total external revenues while keeping medical costs at $84,450. Similarly, the Medicare segment showed impressive results with $37,210 in total external revenues and $34,227 in medical costs. The commercial segment also performed well, bringing in $42,003 in total external revenues and maintaining medical costs at $36,902. On the other hand, the other/elimin segment struggled significantly, recording only $5,130 in total external revenues. This stark contrast highlights a notable disparity in performance across different segments and regions within the organization. The management is optimistic about the company's outlook, citing several key drivers for growth. The company's focus on delivering healthcare services with a personal approach, using local brands and teams, has positioned them well for long-term success. Specifically, they expect to drive growth through the DSNP opportunity, which leverages their integrated Medicaid and Medicare Advantage footprints. The management is also confident in the company's financial performance, highlighting strong operating results, including $5.1 billion in cash provided by operations in 2025. They have invested in system enhancements and computer hardware, with capital expenditures of $767 million in 2025, and are repurchasing stock, with $475 million in stock repurchases in 2025. In terms of risk management, the company has a strong liquidity position, with unregulated cash and investments of $1.5 billion at December 31, 2025. They may elect to increase borrowings on their revolving credit facility or raise additional funds through debt or equity issuances. Overall, the management's strategy is centered around driving growth through strategic partnerships and investments in technology and infrastructure. They are confident in their ability to manage risk and ensure the safety of their assets, while also prioritizing liquidity, capital preservation, and maximizing returns on invested assets. The company has made several strategic moves through acquisitions and divestitures to shape its business strategy. On the acquisition front, the company has expanded its presence in new markets by acquiring health plans participating in government-sponsored healthcare programs, contract rights, and related assets of other health plans. It has also acquired Magellan Rx for $1.3 billion in December 2022 and Magellan Specialty Health for $646 million in January 2023. In addition to these acquisitions, the company has made strategic divestitures to optimize its business portfolio. The sale of Circle Health Group for $931 million in January 2024 is one such example. The company has also announced plans to divest Collaborative Health Systems for $17 million pre-tax and $13 million after-tax in October 2024. Furthermore, the Magellan Health businesses are expected to be divested by December 2025, resulting in non-cash impairment charges of $513 million or $389 million after-tax. The company's decision to terminate its Essentials Plan -5 by July 1, 2026, is also a significant development that will likely impact its business operations. Overall, these acquisitions and divestitures demonstrate the company's commitment to adapting to changing market conditions and optimizing its business strategy for long-term success. The company has demonstrated its commitment to returning value to shareholders through two key initiatives, paying dividends and buying back shares. In terms of dividend payments, the company has a clear history of distributing dividends to its investors. This is evident from multiple references in the provided summaries, including page 15, which confirms this practice. The company's decision to pay dividends reflects its confidence in its financial performance and its desire to reward shareholders for their investment. The company has also implemented a stock repurchase program, which allows it to buy back shares of its own stock. This program was authorized with a budget of up to $10 billion, as mentioned on page 43. The company has made specific purchases under this program, as noted in various pages, 62, 83, 108, and 122. By buying back shares, the company is able to reduce the number of outstanding shares, which can have a positive impact on earnings per share and overall stock value. That concludes the financial summary for Centene Corporation. Feel free to comment below, and I will be happy to answer them when possible.